Hey YouTube, I want to talk to you today about the situation that the stock market's in. This is from advisor perspectives, November 2021, so it's current, and this is basically my whole life. I want to say that's 1980, right there, 80, 85, 90. I can remember this. This is the crash of 1987. I can remember people losing their jobs, lots of them, and people being worried over this. And here's where we're at today. There's a lot to talk about on this chart. These purple lines right here, and this pink, that circle, and this, they're my additions. This is the dot-com tech bubble, the dot-com crash, the housing bubble, the housing crash in 2008, and, we printed our way out of it. So the pink represents the TARP bailouts under George Bush II, temporary asset relief program that has so far proved to be very much permanent because the Fed has been buying $120 billion of bonds for who knows how long. So this is pretty well government made. This isn't market driven. This is government driven. Because the Fed buys so much Wall Street assets, there's always a buyer. So everything continually rises higher. And I don't want to get too sidetracked. You can extrapolate this crash here, across these peaks or troughs, and you can extrapolate across these peaks of the booms, and this is going to give you the range that this trend should live in. And you can see it's a megaphone pattern because you've got convergent and divergent. You've got either something flails apart or it opens this way or it opens this way. So this is a megaphone, and the trend is to stay within the confines of the megaphone. But obviously asset price has broken out of the ceiling dramatically, 400%. This doesn't happen. I don't think that this has ever happened. So if it has, it's probably 50, 60 years ago, and it's probably got to do with FDR changing the gold standard, which inflated the money supply. And certainly there is some inflation correction needed here. But so just keep in mind that the crash that we're coming into, whether you like it or not, what goes up must come down. I'm not pessimistic. I'm an optimistic person in terms of I'm going to heaven. None of this, I don't have any money in this. I'm not concerned. I have a good life, good family, wonderful wife. So, I could give a crap about any of this. But if you've got your life tied up in all this, you might want to consider. Because I lost my ass right here. All my cash. And then I lost my house. This wrecked me. I managed to cling on into here, but, I haven't recovered from it. So I'm telling you from experience that you ought to smell what the rock is cooking here. This might not go so well for anybody. When things go up that sharply, they don't ever unwind slow. They come straight back down. An unprecedented acceleration in the climb here. But what we need to look at is debt. This is margin trading, okay? So back before the internet, 1992, 94, in that range, and people really didn't start trading on the internet until the dot-com boom. This is just a very small percentage of the population that had the access to trade on credit, on a margin account. So that's when you have assets with Charles Schwab or Merrill Lynch or whoever, and you use your assets, you collateralize them, you promise them to secure lending with interest from a trading broker, and then you invest that money in the markets. Well, the more debt, the more people go on margin and borrow and invest, the more they inflate the prices. But when the asset, when something breaks up and the margin calls go out, that's when the trading house calls you and says you need to start paying us back some because your bets are going the wrong way. When the margin calls go out, they require a sale at any time. They require a sale at any price. So when you're talking about it's called a crowded trade. When the market goes the wrong way, all those people that gambled on it going the right way, they all get a margin call, and they all have to sell. And that flood of shares, it satisfies all of the buying demand. So, maybe at this price, there's, 100 people who are willing to purchase. But if there's 200 people selling, they're gonna oversupply the demand at this price. So the price has to come down. The market makers have to lower the price to get the next tier of interest in buying, and the price just falls. The more the price falls, the more margin calls go out. Now, what you got to see right here is this little white spike. This white spike is margin calls back in 2020 from the COVID train wreck. I think it was May. Just a little short period of margin calls makes asset price go right down. But as soon as it started going back up again, what do these idiots do? They run right back into the lending game. Which, this ought to remind you of some other time period in history. Now, this is the PE ratio. And PE ratio has been getting tracked out for a long, long time. 1880 to 1980 is 140 years. And this is how many dollars you have to buy in I thought my camera stopped recording. How many dollars you have to buy in shares to purchase $1 of earnings? And this is a very long-term trend. So the trends, the ups and downs, that we can remember in our lives, these are, this is a long-term bear market, but there's bullish trends, short-term, and then a crash, and then a bullish trend, and then a crash. So there's a bear market right there. Here's a bull market right here. Here's a bear. Here's a bull. Well, that 1921 bottom price, the Roaring '20s, was full of what? It was full of people borrowing money to put it in the stock market. And that made an overvaluation. The estimate of what stocks were really worth got outrageously overvalued. And when I was born, this was the worst it had ever been, because I was born right here. So this was the highest overvalue ever until the dot-com era. Now, the dot-com era marks the outrageous high peak, and then you had your housing. This was the housing boom. In PE ratio, this was the housing boom. The thing about PE ratio is it's like a football game. You have to go to the high end, the end zone on the high side, resets the ball, and then now it's going to go to the end zone on the low side. When you cross that, there's 5, and there's 17, I guess. There's not necessarily a consensus on what marks the high and the low, but this is definitely through the high end zone. This is definitely through the high end zone. That is definitely through the high end zone. The issue is that you have to cross, just like football, the ball's got to cross the end zone, 4 downs or whatever, and the ball changes hands, which doesn't really apply to this analogy, so maybe it's dumb that I said it, but the ball crossed the high end zone. Now it has to go to the low end zone. When you interrupt the market cycle, you spoil it. It's rotten now, okay? And we did that by printing our way out of going to the reset. What needed to happen was all the jackasses who leveraged themselves to death on malinvestments on Global Crossing, fiber optic company, and things like that, bad bets, Blockbuster Video. Those people didn't need to be bailed out. Wall Street doesn't need to be bailed out. It needs to be shipwrecked. It needed to come down here. Because of the size, look at the deviation from the mean. The slingshot went, how many rungs up? It needs to go how many rungs down. But we didn't let it. We had a boom and decided we were going to print our way back to the next boom without the crash. The crash is what squeezes out the pus, the bad investments, okay? And we tapped into the taxpayers and bailed out the assholes. And this is what you get. This is what you get. You get, let's look again. This bottom should have been down here, which if we had the appropriate slope, it would be like this. Which means when this thing crashes, it's probably going to go not to this bottom, but to the appropriate one that's baked in, somewhere down off the screen. The kind of thing that, the unfathomable, the Hindenburg, not to sound too pessimistic, but economically, the Hindenburg of crashes. Now, since we have no more gold standard, which that was 71, which is a little off the chart, which allowed us to start printing our way into this, and then we started an era of bailing out the bad investments because, the bankers fund the Congress critters and they all look out for each other. Money tricks is what allowed this curve to be possible. This is not genuine free market. This is a manipulated, corralled market. It's kind of like a Cornish cross chicken sitting for 24 hours a day in front of a feeder. It's just going to eat. And that's what this is. This is a feed trough for the rich. And the middle class is invited to put their 401k in it and go along. But I guarantee you, from my own experience back here, when the news says it's time to sell, the last 5 years of your contributions is already gone. They're gone forever. And if you're in up here, do you think it will ever go down and come this far back up? Not without printing money to death. Look at what your money buys. If you lose your money here, and then you have to wait 1, 2, 3, 4, 5, 6, 7, 8 years to get back to zero. You lost that. Let's say you had $100,000, you lost it, or you rode this out. You didn't sell, so you didn't lose it. You hung on tight. It went down to 40, 50, 60,000. It comes back up to 100,000. The problem is, how many years later? The 100,000 buys half up here what it used to back here. 100,000 used to buy a house here. 100,000 over here buys a pickup truck. So, when you lose money in here and it takes 20 years to get back there, you'll be penalized 70%, probably based on inflation. Because when this crash happens, what do you think they're going to do? They're going to print their way out of it. So they're going to quadruple the money supply. We'll have wheelbarrows of money for bread. See, there's no getting out of this. The Fed, in my opinion, they're hijacked. The Fed has lied and lied and lied about what inflation is. It's dilution. There's not a measurement for what they're doing. Printing money to death is dilution. That's what the Bolsheviks did in 1919. Inflation is when genuine business is creating genuine economic gains, and the manufacturing can't produce goods fast enough to match it. This is free welfare money. It's handouts to the low class. It's handouts right now to the middle class, and obviously the upper class never. They don't need a handout, but they never lose. The 1%. But either this has to crash to get these numbers right, or the money has to be printed to oblivion to make this dystopian chart continue on. There's no easy way out of this now. Either the money crashes or the stock price crashes. When the Fed is tapering their welfare to Wall Street program right now, and they're talking about accelerating it, and they're going to raise interest rates. So every time they've ever done that, there's been a taper tantrum. That's your 2016 right here, taper tantrum. Then I think this was another one right here. When the interest rate goes up, the taper comes in, and the margin calls go out. What is this lead balloon going to do? It's going to break through that floor so damn fast that it's going to make your head spin.